All right. So I want to make a note first. My approach for these questions, always identify the three things as soon as you get into a question. Identify, is it LIFO, FIFO, weighted average? Okay, well, let's see, where is it? Okay, here it's telling us to use the weighted average and LIFO methods. So I identified that. Now, a normal question is just going to have one, right? This is me going through a few for you. That's fine. Is it perpetual or periodic? Periodic. And are we trying to find cost of goods sold or ending inventory? Well, in this case, it's both, right? But always identify those 3 points. What method? Are we perpetual or periodic? And then what are we trying to find? Because the question is very different depending on each of those, right? All right. So good there. And the reason why we're doing more than one is just, it's nice to see the difference. You change one thing, what happens? All right. So we see here, Frost reports the following transactions. Here are the transactions. And we have 40 units on hand at the end of the year. We use the periodic. Well, let's take a look. Okay. We're doing the average weighted, the average method. So we're going to average them all together to get our per unit cost. Well, our per unit cost is averaging 10,000 divided by 840 here, right? 10,000 divided by 840 gets us $11.91 roughly per unit. Now, generally for problems, I like to leave them unrounded until the very end, right? I would definitely recommend doing that, and then round your very last number in the question. We're trying to find cost of goods sold and ending inventory. Well, cost of goods sold, right? How many were sold? We saw previously that what? Well, we saw 40 units on hand. 40 units were left. We had total purchases of 840. That means sales were 800, right? That they could tell you how many were sold. They could put transactions in between these purchases and say those were sales, but we just know that there were sales of 800 throughout the year. So that's how we get our 800 times $11.91 for our total cost of goods sold of $9,524. That is our cost of goods sold for our weighted average method. Each question a little different, a little versatile, right? You got to practice these and practice getting the tricks that are thrown at you each way. Now, ending inventory, this one's as simple as, okay, well, what's left? 40 units is left times our rate. And this is our ending inventory for our weighted average method. Nothing crazy. You got it. All right. What about our LIFO method? Our last in, first out. Okay. Let's see here. We're dealing with periodic, and I guess now's a good time to deal with perpetual versus periodic. Perpetual method. So this is kind of think of a more, and I'll give you general terms and then we'll get into how it applies here. So perpetual method, think of it like a computerized system where it constantly counts your inventory over and over. So it recalculates every time you purchase some inventory. Periodic, think about it like the period, right? So we're going to wait until the end to calculate. It's more manual. You may see questions that ask about this very rarely. You just need to apply them. But generally, perpetual method, they say, is more expensive because it's a computerized system, right? A computerized system that calculates your inventory throughout the period. Now, for periodic, this is going to just be you recalculate it at the end of the period. That's going to affect us, in a couple different ways, depending on when we have our sales, right? Because if we're dealing it just jumping to the end of the period and then kind of going in here and doing it, that's going to be different than if we just recalculate every point along the way. That's perpetual versus periodic. Now, what are we doing here? Okay, we have the same info as everything before, right? Same as weighted average, but we're dealing with it a little bit different. It tells us we have our, same amounts, 200 purchases at $10. It gave us the total amounts before. Now we need to calculate our cost of goods sold and ending inventory. Okay, great. Well, ending inventory is the same, right? It's 40 units still, so there's our 40 units. Cost of goods sold. Okay, well, we are doing last in, first out. So the last in, we start from this part. We start from the beginning. And if they didn't give us these amounts, we'd have to just, simply do 3,600 divided by 240 units gets us $15. So we start with the last units. The last purchases in were the September 19th, right? Because that's the most recent. So we essentially are saying, okay, we have 3,600 of cost. So that takes us down 240 of 6. We have, what do we have left? 240. That's 600 units left. All right, great. Now we take up the remaining units here. Awesome. Sounds good. and then we are going to arrive at an additional 4,400 units. Now here, we leave 40 units. So right here, we cross this out and write 40, because 40 units are left, right? 40 units are left. We needed our total amount there. 40 units are left. 40 units at the cost of $10 per unit gives us an ending inventory of $400. Our total cost of goods sold here, final amount here, is just going to be this $9,600, right? So that's our ending inventory. Nice, simple process. Nothing too crazy. Nothing too out there. You got this, right? Cost of goods sold and ending inventory. So our total inventory, right, minus our cost of goods sold, another way to get our ending inventory. That is our LIFO method. And FIFO would just be the same thing, just going from the other way, right? First in, first out. So we'd take 40 units of this bucket, right? So 40 units at $15, that would be the ending inventory for the FIFO method. Just seeing what happens if you change something in each method. Cost flow assumptions. So using all three methods, the ending inventory in units is the same. However, the cost is different, and that's what you're calculating, as we've seen, right? In units, it's the same, right? In all the methods, it was 40 units left. 40 units was the ending inventory, but the cost of those units is what is different. The cost of goods sold and the cost of ending inventory different, but the cost available for sale is the same in all three methods, right? So the total cost of goods that are available for sale in that period, that is the same. In a period of rising prices, LIFO reports the smallest net income. And you can prove that by going through here. LIFO is going to have the smallest net income because it has the highest cost of goods sold, because you're dealing with a period of rising prices and you're taking from the most recent. That's the whole process. I would definitely memorize those, like which methods result in the highest and lowest net income, cost of goods sold in each period of rising and declining prices.